Hello everyone and welcome back to the channel. In today's video, I'm going to be sharing how to get the best and lowest mortgage rate possible when buying your first home. So, if you're new to the channel, my name is Henry. I'm a mortgage broker based in Illinois and Indiana. I wanted to make this video for you guys, sharing different strategies that you can implement regardless of what program you're using. These strategies will help you save thousands on interest and get you the lowest rate possible. So, if that sounds interesting, let's make sure that you stay to the end of this video. Without further ado, let's get started. Alright, number one is going to be your credit score. Now, this is something a lot of people know, but let me just break it down for you so you can see how impactful this is. It's one of the major factors that determine whether you're going to get a higher or lower interest rate. Here's an example. This is the test scenario for someone with a 680 credit score and someone with the 800 credit score. For this test scenario, the person with the 680 credit score qualified for an interest rate of roughly 6.9%. The person with the 800 credit score qualified for an interest rate of 6.3%. So, what does this mean? For a $450,000 home, that will be a monthly savings of roughly $175 just because the person had an 800 credit score. As you can see, it's a big difference, not just in interest rate, but also in the amount of money saved on the mortgage payment. I would also recommend having a 760 credit score and above to get the best possible rates. All right, number two is putting a bigger down payment. Now, this is actually one I don't recommend, but it is a tool that you can use to get a lower interest rate. When putting down a bigger down payment, the bank sees you as less risk because you're investing up front. With loans, whenever there is less risk for the bank, the interest rate is lower. Whenever there's more risk, the interest rate is higher. So, for example, if you're putting 20% down instead of 5%, banks are willing to give you a lower interest rate. Here is an example based on the same $450,000 scenario. Someone putting down 5% will get an interest rate of roughly 6.3%. Someone putting down 20% will get an interest rate at roughly 6%. What does this mean number-wise? That will be a monthly savings of roughly $900 for the person putting 20% down. They would also save roughly $100,000 in interest over the span of a 30-year mortgage. Now, you're probably wondering, Henry, that's a lot of savings. Why wouldn't I put down 20%? The reason I don't usually recommend putting a large down payment is, even if you have it, it's because in this case, you need to put roughly $85,000 down more in down payment. In return, you only be saving about $450 a month. I'd rather put 5% down and keep the other $85,000 in my pocket than just save $450 a month. All right, number three is working with a mortgage broker. What is a mortgage broker? A mortgage broker is a loan officer who works with multiple banks. For example, I'm a mortgage broker, and in my company, I work with over 250, 275 different banks. This allows me to take an application and shop among different lenders to find the best interest rates for my clients. Just because one bank offers a 6% rate doesn't mean another bank won't offer 5.8, 6.2, or even 5.1%. That's why it's very beneficial to work with a mortgage broker. They have access to multiple banks to get you the lowest rate possible. Now, there are also other type of loan officers, and you may be wondering, well, Henry, my loan officer said that they do that too. There are three type of loan officers. First, there's a mortgage broker, which I just explained. They shop different banks for you. Second, there's a direct lender who works under one bank that focuses only on mortgages. I actually started as a direct lender, but I left because my interest rates were always higher than the mortgage brokers since I couldn't shop around. So if you work with a direct lender, I recommend checking with a mortgage broker because they can almost always get you a lower rate. Third, there's a retail loan officer, like those at Wells Fargo, Chase, or U.S. Bank. These lenders sometimes have good rates, but they tend to be very strict with their guidelines. So that's a quick summary of the three type of loan officers. Again, I recommend working with a mortgage broker so they can shop around and get you the lowest rate. All right, number 4 is discount points. What is a discount point? A discount point is when you pay money in exchange for a lower interest rate. The thing about that is that you can either pay it or the seller can pay it. You may be thinking, why would I pay money to lower my interest rate? I don't want to pay extra. Well, seller can offer credits to cover this cost. These are called seller credits. A seller credit is when the seller agrees to pay for a part or all of your closing costs, including discount points. How do discount points work? It varies by loan program, but the basics are simple. A bank may say, our standard interest rate is 5%, but we'll offer you 4.2 if you pay 2 points, or 2 points of the loan amount. I don't always recommend buying discount point, especially if you're paying for them yourself, but if the seller's going to cover the cost, that's up to you whether or not you want the money to go towards your closing costs or buy down the interest rate. One quick note about seller credits is extremely important to work with a great real estate agent. A skilled agent will negotiate seller credits for you, which can be used to lower your interest rate. If your agent lacks experience, they may not be able to secure as much, if any, seller credits at all for you. If you don't get seller credits, you won't be able to use them for discount points to reduce your rate. So when choosing an agent, make sure that they have strong negotiation skills. That way they can maximize your seller credits and help you get the lowest interest rates possible. All right, number 5 is having everyone's credit score on board. What do I mean by that? When you apply for a mortgage, banks don't just take the highest score possible. Everyone has three scores. One for Equifax, one from TransUnion, and one from Experian. The bank uses your middle score, but if there's multiple borrowers, they use the lowest middle score among all applicants. For example, let's just say that you have a middle score of 720 and your partner has a 650. The bank will use the 650 score even though you have a higher score. As we discussed earlier, credit scores plays a huge role in determining your interest rate. So make sure everyone who will be on the mortgage application is working towards a strong credit score. Ideally, aim for a 760 or above to get the best rates. And that's pretty much it for today's video. Hopefully you guys enjoyed it. Comment below what you thought. Leave a big thumbs up, and we'll see you in the next one. Be great.